We all believe that this euphoria is going to carry us with Trump, and there's no, all of the craziness is behind us, all of the debt is behind us, all of this bad stuff is behind us, so the market can go forever. Yet the insiders are bailing, and Warren Buffett's sitting on over, $40 billion in cash.
When bond yields start rising, equities go with it. They go into new high ground. But there comes a point, perhaps after a bit of a pause, where there's another wave of rising bond yields, and it's that kills the equity bull. We're going to see that, I think, in 2025.
When this whole thing goes down, mark my words, the great taking is very real, and a lot of people, a huge amount of people, are going to be left with nothing.
You're watching Silver News Daily. Subscribe for more.
Did you know that Warren Buffett, the Oracle of Omaha, is sitting on over $145 billion in cash, bracing for what he believes is the next financial storm? And he's not alone. Other market insiders are dumping stocks and piling into cash and tangible assets at a record pace. What do they know that the rest of us don't? Stay tuned, because what's happening behind the scenes right now could completely reshape the financial markets in 2025, and it's a story you can't afford to ignore.
The little guy, I think all of us have noticed that, we've got more sales this year than probably the previous 3, 4, maybe even 5 years combined. I believe that is not a function of, if you want to call it financial markets, I believe that's a function of the real economy. The real economy, because of inflation, because of joblessness that's not reported, people are needing to fall back on their savings. And we as gold, silver people, we've seen these people buy over the years. We didn't see them sell because the real economy was not as crappy as it is right now. The real economy worldwide is slowing down. Now, I've talked about this probably 10 times in the last 3 or 4 months. But if you took, I use just the US, but it should be looked at it worldwide. If you took the deficit spending that the US has done just over the last 5 years, $15 trillion of accumulated deficits. If we didn't have those deficits, that money, that 15 trillion, would not have been part of the real economy. It would not have been part of GDP. And we would have been reporting, instead of 1.5, 2.5, 3% growth, we would have been reporting 3, 4, 5, 7% decline. And that's the case worldwide. The deficit spending, the use of credit, is masking the fact that GDP is no longer getting a boost by a multiple out of every dollar that's borrowed. That's actually getting a boost of less than 1-to-1 for those deficits that have been borrowed. So there's your math right there. We've hit debt saturation.
Let's talk about what the smartest people in the room are doing right now. Warren Buffett, often hailed as the greatest investor of our time, isn't buying into the stock market euphoria. Instead, he's sitting on an unprecedented $145 billion in cash, his largest cash position ever. But he's not alone in this move. Jeff Bezos, one of the richest individuals in the world, has sold over $13 billion worth of Amazon stock in just the last year. Mark Zuckerberg has unloaded $2.4 billion in Meta shares, and insiders at NVIDIA, the darling of the tech boom, have sold over $2 billion in stock this year alone. Insider selling now outpaces buying at a staggering 6-to-1 ratio. These aren't random sell-offs. They're calculated moves by people with the most intimate knowledge of their companies and broader markets. Why are they doing this? It's because they see the storm clouds on the horizon. Rising bond yields, slowing economic growth, and unsustainable levels of corporate and government debt are creating a toxic brew that could poison the financial markets. The insiders know that when this bubble bursts, It won't just be a minor correction. It could be the financial reckoning of a generation. And it's not just individual insiders making these moves. Central banks around the world are stockpiling gold and silver at record levels. China, for example, has quietly accumulated over 1,000 tons of gold since the start of the Ukraine war. They've also been shedding U.S. treasuries, signaling a growing lack of faith in the dollar. The question you have to ask yourself is this: if the insiders, with all their resources and knowledge, are retreating to cash and tangible assets, why is the average investor still chasing the highs in the stock market? Are they seeing something the rest of us are missing?
Yeah, sure. My experience, long-standing experience as a stockbroker, is that markets tend to move in about three waves. I mean, this is true of equity markets, but the psychology, I think, is very, very similar. And that is, after a bear market, the only people who participate early in the next bull market are basically the people who really know what they're doing. The real pros. The guys, for example, sort of in, let's say the mining industry, something like that, who understand mines. They're in there buying stuff, and it's sort of accumulating in their hands. You get M&A activity. This sort of thing begins to build. And as the M&A activity begins to build, then you find that there's a wider investment community. But again, very much investment managers, experienced guys who will go in and drive the second wave. And towards the end of the second wave, some of the public begin to sort of think, markets are going up. Perhaps we ought to buy some. You then get another correction. I mean, Elliott Wave fans will know, will feel the description. But then the last bit is the last bit of the bull market is where all the idiots, who've missed it, pile in because they know they're missing something and it's going up, and they buy it just because it's going up. Now we are, if you like, in those terms, in phase one. And so to see the public selling while the professionals are buying, which is what Andy was saying, is exactly what's been going on. It's that very, very early stage. You can take these comparisons a bit too far because obviously we're not talking about investment, we're talking about protection. And we're talking about getting out of credit and getting into money. But the psychology basically is the same. I mean, even Germany, who's had two wipeouts, currency wipeouts, since the 1920s, 1923 and also following the Second World War. I mean, they're not buying gold. People are not buying gold. They're not sort of putting some aside. They've been selling. And if you look at, ETFs, the dreaded ETFs, which are not a substitute for gold or silver, it's only recently that there has been a little bit of buying, if you like, in Western capital markets. But that buying hasn't been really individuals. It's been some of the funds, run by guys who maybe listen to us a little bit and have got this sort of idea that gold is actually something you should have, or a little bit of silver if you want to speculate on EV and all this sort of stuff. So it's only just starting. And so really to summarize, the fact that the retail market has been sellers this year while the professionals have been buying is actually the clearest indication that you've got that this is in the very, very early stages of a big, big bull move.
Now let's dive deeper into the heart of the problem: debt saturation. Globally, debt levels have reached astronomical heights, creating a ticking time bomb in the financial system. Governments, corporations, and households have been borrowing at breakneck speeds for years, but now the cost of servicing this debt is rising, and fast. Take the U.S., for example. In the first 2 months of 2025 alone, the government spent a staggering $584 billion, an unprecedented start to the fiscal year. A large chunk of this was simply to pay interest on the national debt, which has ballooned past $33 trillion. Think about that. We're borrowing money just to stay afloat, and the cost of that borrowing is skyrocketing as bond yields climb higher. But it's not just governments feeling the squeeze. Corporate America is groaning under the weight of leveraged debt. Over $1 trillion in commercial real estate loans are set to mature this year, with many companies struggling to refinance at today's higher rates. Zombie companies, businesses that can't even cover their interest payments with current earnings, are now at risk of collapse, threatening to take down entire sectors with them. For households, the story isn't any better. Credit card debt in the U.S. has surged past $1 trillion, and delinquency rates are climbing. Rising mortgage costs are squeezing homeowners, and auto loans are becoming unaffordable for many families. The global debt bubble has reached its breaking point. For years, low interest rates masked the true cost of borrowing, but now the bill is coming due, and as the cracks in the system grow wider, the risk of a full-scale financial collapse becomes harder to ignore. So what happens when this bubble bursts? How do markets, already stretched to their limits, handle the shock of widespread defaults and a shrinking credit supply? These are the questions that will define 2025 and potentially your financial future.
Well, I think what the banks are doing is what they've also been doing in 24. That is, they're trying to de-risk their balance sheets. Now, an individual bank can reduce its balance sheet. Point being that the leverage within the banking sector is uncomfortably high. And it became uncomfortably high because margins were suppressed at the time when we had zero interest rates. And, if you look at the banking systems in Japan and also in the Eurozone, where they went, where the central banks drove interest rates into negative territory, I mean, the leverage there is far greater. So, leverage is a function, if you like, of how the banks responded to the suppression of interest rates. So they're now left with higher interest rates and too much leverage on their balance sheets. They're trying to reduce that. The system as a whole cannot reduce its balance sheet for the very simple reason that once credit is created, it doesn't disappear. I mean, people make the mistake of thinking that, we get into a deal, we do the deal, I pay you, you deliver to me, end of credit. No. What happens is the credit gets passed on to other parties. If I pay you, it goes into your bank account. And if you pay someone else, it goes into someone else's bank account. All that's credit. And even cash is credit. It's not proper money. So the point is that you have the entire system trying to de-risk itself, not by, in aggregate, reducing its overall level of credit, but by, if you like, taking funds away from the private sector and applying them to government, and specifically applying them to government through the T-bill market rather than longer-term maturities. That's the way in which the banking system de-risks itself. The problem with that, obviously, is that it kills the private sector. And, Bill made the point earlier about, the falsity of the GDP numbers, because so much of it is actually the expansion of government credit, which is it's inflationary. It's not it's not credit aimed at production in any sense. Production in the sense that the private sector is producing something that people actually want, that they will actually demand. No, this is credit which is produced by a government which says, you will have this, you will have that. Now, this is inflationary. So this is the background against which the banking system operates. Now, there are ways in which the level of outstanding bank credit can be reduced. The first is businesses go bust. And I think we're going to see quite a lot of that in 2025. And the second is that banks go bust. If you look at what happened in the 1930s, when money supply contracted by something like 40%, it weren't because the credit was sort of, if you like, being, contracted by the banks. No, it was because banks were going bust and businesses were going.
Let's zero in on a critical piece of this financial puzzle: rising bond yields. For years, low interest rates created a false sense of security, fueling the longest bull market in history. But now the game has changed. Bond yields, especially on long-term U.S. Treasuries, are climbing steadily, with the 10-year yield nearing 5%. While that might sound like a small number, it has massive implications for the global economy. Here's why. Rising bond yields increase the cost of borrowing across the board. For governments, this means higher interest payments on already massive debts. The U.S. is now spending hundreds of billions of dollars annually just to service its debt, and as yields climb, that number will only grow. For corporations, the picture is equally dire. Higher yields mean more expensive loans and refinancing costs, which eat into profits and stunt growth. Companies that thrived on cheap credit during the low-rate era are now struggling to adapt. Many are cutting back on expansion, laying off workers, or even facing bankruptcy. And for everyday consumers, rising yields push up mortgage rates, car loans, and credit card interest, making it harder for families to afford homes, vehicles, or even basic necessities. It's no surprise that delinquency rates are creeping upward, putting further strain on the financial system. But the impact doesn't stop there. Bond yields also influence the stock market. When yields rise, investors begin to question the high valuations of equities. Why take the risk of owning stocks when bonds offer safer returns? This shift in sentiment can lead to a mass exodus from stocks, triggering sharp declines and increased volatility. What we're witnessing now is the beginning of a painful repricing across asset classes. Rising yields are forcing the market to confront an uncomfortable truth. The days of easy money are over, and the consequences of that shift are only just starting to unfold. The question is, how far will yields climb before the system reaches its breaking point? And when that happens, where will investors turn for safety?
In commercial real estate loans coming due in 2025, with interest rates moving higher on the back end, and it's not the federal funds rate that matters. The economy runs on the 10-year Treasury. I mean, the mortgages and the credit cards and the leases and all of these things, they're all about the long end of the bond market, which is moving in the other direction. What havoc is that going to wreak on the banking industry? What havoc is that going to wreak in the commercial real estate? And I keep coming back to this thought of restructuring. I mean, Trump is the bankruptcy king. I mean, is this something that's baked into the cake? Do they know that we're going to have to reset some way? And is he here for that reason? You know, I've done interviews with people like Simon Hunt, who will tell you that he was selected, not elected, and he was selected to usher in this digital surveillance state. He talked months ago with me about they're going to issue a digital ID under the guise of election integrity. What do you know? He just said that. A lot of the things that I guess I'll just simply say this. And someone said it to me very apropos. He said, you know, is Trump the Trojan horse, or is he riding on the Trojan horse? And that, I don't know. And I guess I would just simply say this after what we've been through for the last 4 years. If you don't look at everything cross-eyed, if you don't think outside the box, everything that's presented to us, I think you've missed everything that we lived through for the last 4 years. So as happy as I am that he's here, you have to wonder, what does it ultimately mean? I mean, what better guy to have oversee a bankruptcy or a restructuring or a reset than someone who's known for doing that professionally, maybe better than anyone. So I think there are a lot of things to keep your eye on. Most of them center around debt. And the BRICS have not lost sight of that. So don't underestimate the BRICS. Don't lose sight of the debt. Be optimistic, but understand that they're just like in the Shawshank Redemption, as I said with you before, Dunnigan, you have 2 miles worth of crap to crawl through to get to the other end. And maybe there is reason to be optimistic, but there is no way of getting to that other side without dealing with the mountains of debt and that tunnel full of crap that we have to crawl through. So I think 2025 is going to be a volatile year. And when the president-elect says this next year could be 1929 style depression, thanks to what we've seen already by the Democrats, I think people need to, and then see 6-1 insider selling versus buying. I think we need to be cautiously optimistic into the new year.
Let's talk about one of the most subtle but critical factors driving today's financial landscape: Market psychology. In every major economic shift, sentiment plays a pivotal role in determining what comes next. And right now, confidence is unraveling. For years, the stock market has been buoyed by a sense of invincibility. Investors believed central banks would always step in, interest rates would remain low, and the economy would keep growing indefinitely. This mindset, often referred to as irrational exuberance, has driven valuations to unsustainable heights. But now, cracks are forming in this narrative. Rising bond yields, soaring debt levels, and slowing economic growth are shaking the foundation of market confidence. Insider selling, as we discussed earlier, is a clear sign that those with the most at stake are losing faith in the market's ability to defy gravity. Adding fuel to the fire is a growing distrust in fiat currencies. Central banks, led by the U.S. Federal Reserve, have printed trillions of dollars over the past decade to prop up economies. While this provided a temporary boost, it also diluted the value of currencies, eroding purchasing power. Consumers and investors alike are starting to question the long-term viability of fiat money. This shifting sentiment is evident in the actions of central banks themselves. Institutions that once championed the dollar are now hedging their bets, amassing gold and silver at record levels. Why? Because these tangible assets are seen as a hedge against inflation, currency devaluation, and systemic risk. But the general public hasn't caught on yet. Many retail investors continue to pour money into overvalued stocks, clinging to the hope that the bull market will persist. This disconnect between insiders and the public is a hallmark of the early stages of a financial crisis. The question now is, how long can this fragile confidence hold? And when it finally breaks, will you be prepared to act? Or will you be left scrambling, just like the masses?
I know a lot of the rhetoric surrounding the BRICS nations has somewhat died down. I expect to see a reemergence of this discussion in 2025. Trump saying he'll enact 100% tariffs on the BRICS nations for continuing their desire to move away from the dollar. That's not a tariff. Tariff protects manufacturing, domestic manufacturing. That is a sanction masquerading as a tariff. That is financial warfare. That is not something that I think will dissuade the BRICS from continuing to move forward. I think that from a domestic standpoint, I think the debt issue is something that has to be front and center. I mean, even Trump just sent out a tweet the other night saying, thanks to what the Democrats have done, 2025 could be a 1929 style depression. You look at the latest Treasury data that was just released for November, which was the second month of fiscal 2025. The U.S. spent $584 billion for October and November. That's the first 2 months of 2025 for the fiscal calendar year that Trump is inheriting are officially the worst start to a year ever for the Treasury. When I look at gold acquisitions, again, China doesn't buy gold for no reason. And they've bought 1,000 tons since the start. That's what they tell us, since the start of the Ukrainian war. At the same time, they've sold $250 billion of our U.S. treasuries. This is a trend that will continue. This de-dollarization will continue. I think they'll continue to accumulate gold rather than try to devalue their yuan against the dollar. They'll let it happen organically by accumulating gold. I think that's something certainly to focus on. Of course, it's the bond market. At the same time, I think the bond market, or with the Fed creating trillions to fund these deficits, that not only that they're inheriting, but the debt that is coming due. I think the bond market's getting very nervous that they see inflation coming back, that the ballooning U.S. debt is something that has to be dealt with, and how many treasury securities will have to be created to do so. At the same time, many of the countries that traditionally supported our debt are moving in the other direction. So I think that's something that we'll have to continue to watch very, very closely. But yeah, I mean, if I had to guess, I would say also we're not out of the woods yet regarding the banks. And I'll keep coming back to what happened in Lindsay, Oklahoma as a trial balloon. They didn't say a word about it on the media. I mean, it was literally just kind of stuffed under the rug, and yet it's the first bail-in in this country with over $1 trillion.
Now let's turn our focus to silver, a commodity that's often overlooked, but is quietly becoming one of the most critical assets in the financial and industrial worlds. Silver isn't just another precious metal. It plays a dual role as both a monetary hedge and an industrial powerhouse. First, let's talk about its monetary value. In times of financial instability, silver has historically served as a safe haven asset. Like gold, it offers a tangible store of value that's immune to the risks of fiat currency devaluation. But what makes silver particularly interesting is its affordability compared to gold. This lower price point makes it accessible to a wider range of investors, driving demand during periods of economic uncertainty. Now let's explore silver's industrial importance. Silver is a vital component in a wide range of technologies that are shaping the future. Its unmatched conductivity makes it indispensable in electronics, from smartphones to solar panels. And as the world shifts toward renewable energy, silver's role in solar technology is only going to grow. In fact, demand for silver in solar applications is projected to hit record levels in the coming years. But here's the kicker. The silver market is already in a supply deficit. According to the Silver Institute, demand outstripped supply by 182 million ounces in 2024, marking the fourth consecutive year of deficits. This supply crunch isn't just a temporary blip. It's a structural issue exacerbated by rising industrial demand and declining physical investment. Meanwhile, central banks and wealthy insiders are quietly amassing silver alongside gold. Russia has openly announced its plans to purchase significant quantities of silver, and China has been buying it through covert channels. These moves signal a broader recognition of silver's growing importance in both economic and geopolitical terms. The takeaway: silver isn't just an asset, it's a strategic play for the future. Whether it's used as a hedge against economic turmoil or as a cornerstone of green technology, its value is set to rise. The only question is, will you recognize its potential before it's too late?
2025, I think 2025 is the year where this comes to a head. We had off record, we were talking about why the Bank of England, I guess it was 2 or 3 weeks ago, announced that they are, as of January 1st, they will not report any bailouts of non-financial or non-bank institutions. And the question is why? Why January 1st? Why 2025? And I mean, what comes to my mind is that there are problems. They know they're going to have to address them in 2025, and they don't want to start, if you want to call it, a cascading bank run by naming names. I also believe that 2025 is going to be the year where you're going to see a differential of market rates, not necessarily interest rates that the central banks are using, but how those sovereign treasury bonds are valued. And I think 2025 is going to be the year where there is discernment between credit A, credit B, credit C, based on risk premia, which does not exist. I mean, if there was risk premia that existed, Japan, you would have interest rates at what? 15, 20, 30%. I mean, they're 300% debt to GDP. You'd see the U.S. with higher rates than what we have. So I think this will be the year where sovereign treasuries are looked at based on their metrics, as opposed to they're just another sovereign. They're just another sovereign treasury, and everything's fine. So I think that's something that's going to come up. And I also think that because the entire system is a Ponzi scheme, we're really looking at a global debt trap from the standpoint of we've reached debt saturation, and any Ponzi scheme cannot continue unless there's new money that comes in. And the way new money is created is largely by debt. I mean, it's no longer printed like it was during Weimar Germany. And the fact that we are at levels now where, I mean, looking at the U.S., we're paying over $1 trillion in interest. This year, it'll probably be $1.5 trillion. And within 2 or 3 years, we'll be paying over $2 trillion. And that's if interest rates stay where they are. But to be clear, I do believe interest rates are going to rise from here. So that interest expense is going to come into focus faster and faster. And that blows up the system. It blows up the Ponzi scheme if new money doesn't get borrowed, because that's the lifeblood to both the financial markets and the real economy.
Let's delve into what some are calling the Great Taking, a seismic shift in wealth and power that could leave millions of people exposed and unprepared. But what does this mean, and how is it unfolding right before our eyes? At its core, the Great Taking refers to the way insiders and institutions are positioning themselves to capitalize on a financial collapse, while the average investor is left holding the bag. Imagine this: as markets falter and debt bubbles burst, insiders, armed with early knowledge and vast resources, are shifting their assets into cash, gold, and silver. At the same time, retail investors are still pouring their savings into overvalued stocks, unknowingly fueling the very bubble that is about to explode. This isn't just speculation. It's backed by data. The insider-to-outsider selling ratio is at a staggering 6-to-1, and major players like Warren Buffett and Jeff Bezos have moved billions into safer assets. Meanwhile, central banks are hoarding precious metals at record pace, with China covertly buying over 1,000 tons of gold since the Ukraine war began. Why are these powerful entities taking these actions now? Because they understand that when the system falters, it's not the wealthy who suffer the most. It's everyone else. As credit dries up in financial systems buckle, insiders will be positioned to buy distressed assets for pennies on the dollar, consolidating even more power and wealth. And what about the rest of us? History tells us that during economic upheavals, those who aren't prepared lose everything, from their investments to their savings. This isn't just about money. It's about who will control the resources, the industries, and the opportunities in the post-collapse economy. The key question you need to ask yourself is, are you going to follow the herd and hope for the best? Or will you take proactive steps to safeguard your wealth and future before it's too late? Because make no mistake, when the rate taking is over, the financial landscape will look nothing like it does today.
Bond yields, I mean, particularly US 10-year Treasury bond yields go through 5%. I reckon that US equity markets will crash. It's quite simple, because the relationship between bonds and equities is already very, very stretched. And, going back to my experience as a stockbroker, noticing how markets top out, what tends to happen is that when bond yields start rising, equities go with it. They go into new high ground. But there comes a point, perhaps after a bit of a pause, where there's another wave of rising bond yields, and it's that kills the equity bull. We're going to see that, I think, in 2025, which is going to compound the problems for the banking system, because an awful lot of it is the collateral for loans, just in the same way as commercial real estate is the collateral for loans. And then what's going to happen to residential property, where you've got mortgages, where mortgage costs become unaffordable for increasing quantities of homeowners. As collateral, that's going to be perhaps the last to be undermined, but it'll be undermined. So this is, I think the Fed's attempts to keep the show on the road, kick the can down the road one more time, it's going to fail. They must try it. And that, of course, will kill the dollar, because the foreigners aren't prepared even to help fund the US deficit at 5%, 6%, 10%, 15%. And the Fed is trying to push rates down at the front end of the yield curve. That's just going to kill the dollar. And that, I think, is basically what we're going to see. So coming back to what you were saying, asking about banks, I think banks will be the last to fail in the sense that they will be supported. But it's the whole system which is going to fail. And that's what we face.
Now, let's explore a scenario that many experts are quietly discussing, but few are openly addressing: a potential financial reset. This reset isn't just an economic shift. It's a complete reorganization of how wealth, power, and currency function on a global scale. One of the most significant drivers of this reset is the BRICS nations: Brazil, Russia, India, China, and South Africa, who are openly challenging the US dollar's dominance in global trade. These countries are accelerating efforts to create alternative payment systems and currencies backed by tangible assets like gold and silver. Their moves signal a departure from a dollar-centric world, a shift that could fundamentally alter the global economic order. Adding to the uncertainty is the increasing role of digital currencies. Governments around the world, including the US, are developing central bank digital currencies, CBDCs. While these might seem like a natural evolution of money, they come with serious implications. CBDCs could grant governments unprecedented control over how money is used, tracked, and distributed, raising concerns about privacy and financial freedom. At the same time, the Federal Reserve's balance sheet is a glaring issue. The central bank is deeply underwater, burdened by massive losses from years of quantitative easing and bond-buying programs. The Fed's negative equity means its ability to stabilize the financial system is severely compromised, leaving fewer tools to combat a potential crisis. What happens next could be unprecedented. Some analysts believe the U.S. might resort to a form of debt restructuring, or even a full-scale reset, potentially tying a new currency to gold or other tangible assets to restore confidence. Others warn that the introduction of CBDCs could be used as a tool to manage such a transition, with governments incentivizing, or even forcing, adoption. For investors, this raises urgent questions. How do you protect your wealth in a world where the rules are changing? What role will assets like gold, silver, and other commodities play in a new financial order? And most importantly, are you prepared to adapt to a landscape where old assumptions about money no longer apply? The signs are everywhere, from geopolitical tensions and insider actions to technological shifts and mounting debt. A financial reset isn't just a possibility. It's a looming reality that demands our attention and preparation.
Past. When an obligation is no longer available, the credit on the other side disappears. It's completely worthless. So the point about this is that in 2025, as bond yields rise, and particularly the 10-year, we'll see that go through 5%, I think probably in the first quarter of this coming year. If that happens, and I think it will, then you'll find that banks and businesses will be getting into trouble. So what does the Fed do? It will move heaven and earth, Fed and Treasury, move heaven and earth to ensure that no bank defaults on its obligations to its depositors. So what we're looking at, I think, is a bailout of the entire system. But we have an interesting point about the central bank's involvement in this, because the Fed is deeply underwater in negative equity because of all the losses that it has had from the past from QE. And you think the Fed's got problems, just look at the Bank of Japan. I mean, that's just crazy. Any rise in interest rates there, I mean, the whole system sort of threatens to fall over. The ECB is also in the same sort of position, but not quite as bad as the Bank of Japan. Now, you can recapitalize a central bank quite easily. I won't go into how to do it. But the one thing that actually is going to be very, very difficult is to recapitalize the ECB, because the shareholders, or key holders as they call them, are the national central banks. The national central banks, in most cases, will have to go to the political class to get permission to recapitalize themselves and to, if you like, recapitalize their share of the ECB. That's not going to happen. So I can see that the euro actually could be beginning to just completely disappear under these circumstances in, if you like, a global crash. Now, there is going to be a huge, great panic as people realizing the dangers to credit actually start getting out of credit. What the hell do they get into? I mean, if they try and get into, equities, forget equities, because when you see...
Here we are at the moment where all the threads of this unfolding crisis converge. The debt bubble, insider moves, rising bond yields, shifting market psychology, and geopolitical power plays all point to one conclusion. A historic market upheaval in 2025 is not only possible, it's likely. Here's how it all fits together. As debt saturation reaches critical mass, governments and central banks face a grim choice. Allow the financial system to implode or pump even more money into the economy, further devaluing their currencies. Either scenario spells trouble for the average investor. Rising bond yields will choke economic growth, crush over-leveraged businesses, and send shockwaves through the housing and credit markets. Meanwhile, the BRICS nations and central banks around the world are already preparing for a new era. By amassing gold, silver, and other tangible assets, they're positioning themselves for a post-dollar world. Their actions indicate a shift from fiat currency dependence to asset-backed stability, a move that could leave unprepared investors scrambling to catch up. And let's not forget the great taking. Insiders, armed with resources and foresight, are pulling out of overvalued markets and preparing to swoop in when prices bottom out. The result? A massive consolidation of wealth and power that could leave the majority of investors with nothing but regrets. So what does this mean for you? It means the time to act is now. Diversify your portfolio, prioritize tangible assets like silver and gold, and stay informed about the risks and opportunities in the financial system. Because when the dust settles, those who prepare will not only survive but thrive in the new economic order. Don't wait for the headlines to confirm what we've discussed here by then. It could be too late. Take control of your financial future today. And remember, this isn't financial advice. It's a wake-up call. The question is, will you answer it?